What's up, YouTube? It's Joe Catropolia sitting on the couch, making some money investing in fractional real estate online. Today, I've got a new property that I'm looking at buying that's on Mogul. This is another short-term rental in Houston. It's one that appears to have been operating for 2 years, according to their comments. Um, they're underwriting income significantly below what it looks like, or what I can tell the property's actually been bringing in. So back to being a little bit conservative, which is what I like to see as far as that goes. Um, I'm going to jump into a couple of things, but this hopefully I'll keep this one a little bit briefer than typical because at this point we've looked at three or four different short-term rentals in Houston. So I'm not going to give you any of my thoughts on the Houston market. It is a market that I like. Um, you know, we're gonna do the disclosure now, I guess. Just because I like a property, or just because I buy one, or I invest on a certain platform, doesn't mean that you should. You should do your own due diligence. If you're new to the channel, what I'm doing, I've been a real estate investor for about 20 years. I'm just trying to share my experience while I go through and invest in fractional real estate online. Um, you know, showing you the due diligence that I do, a little bit of my mindset as I'm looking at things, some things to look out for. But this is not telling you, that you should buy what I should buy, what I'm buying, or anything like that. So please do your own due diligence on that stuff. Getting that out of the way. So like I said, I like the Houston market. I think, it has a nice, fast-growing population. There's a lot of things to like about it. But you can look at some of the older videos. There's a link, or there's not actually a link, but there's a playlist in my. If you go to my channel, there's a playlist for all the Mogul properties that I've reviewed. And so if you look at the other Houston STRs, you can see why, in general, this is a plan that I really like. It's a really nice home, 6 bedrooms, 4.5 bathrooms, 3,500 square feet. One of the things, this is one of their first short-term rentals that they have that does not have a pool. It's got a hot tub, but no pool. I don't really like that much. I've found that here in our market in San Antonio, uh, buying with a pool, um, is you just do so much better on average. Our prices to the revenue to price ratios just tend to be a lot better with pools. That being said, this property's been operating for a couple of years, and it looks like it's been bringing in plenty of money without having one. And I think part of it's the location, part of it is just it is set up well. So I'm going to show you a couple of things. I couldn't actually find this as a comp in AirDNA, which is I can't think of a time in the recent past that that's happened. AirDNA usually brings it up, but so I went to this other site, Awning. This is a free site. I don't like the user, the experience quite as much as I like AirDNA because I just think AirDNA is a little bit simpler. But this one, it's easier if you're looking for specific properties. And I knew this one had been operating, so that there'd be this, I'd be able to find this actual revenue from this property. And so 162,780. The reason this doesn't match up with the 130 that they're describing, I believe, is that annual payout, yeah, collections, payout post fees, right? And so I think that what's happening here is we're seeing the difference between pre fees and post fees. That's why that's generally different. But you can see, it's very nice ADR, $763 and 56% occupied. Um, so it's always when the property's been operating and I can find it and I can verify from some third party that the income looks, at least as good as what they're saying, I feel pretty good about it. I've also personally started to trust Mogul, overall. I mean, I'm still new to the platform, but I've talked to people there quite a few times now. I've been involved. I've gotten online every time they do a webinar. They're very sharp guys. They seem to really understand what they're doing. And so I'm starting to trust their decision making and underwriting a little bit. Of course, I still want to verify everything that I can, right? I found the current Airbnb listing. Now, obviously, this is hosted, because this is under contract for a purchase. So this would be the person who had it listed previously, or this is the seller, basically, their listing. but they have 77 reviews. I read through the reviews. I always like to sort by lowest first. This guy just wasn't happy about there not being the hot tub not working. That the they just mentioned, oh well, it was broken at the time, and but everything else, even the 4 stars, were all good. Generally good reviews. A lot of people just don't understand that anything less than 5 is a bad review for an Airbnb host. So I was glad to see that. Um, you can see there are already days booked out into the future. Whether or not, how those are going to get transferred, sometimes it turns into a mess and sometimes it goes smooth. But the property's coming with the furnishings. It's, it is, they'll obviously have to create a new listing for it, but it's, a lot of reasons to believe that it's going to just keep making the money that it is. So I really like to see that. Well, they're actually projecting something a little bit lower. And they've done this. There was at least one other time that they did this, and I think that they're trying to underpromise. So they've realized that if they hit this mid-teens IRR, that they're going to sell out, right? Like, I mean, this just popped up today. They already have $85,000, raised. Now, one of the things, this happened like basically instantly, and so I think that this might represent some investment from their team. They have mentioned that the founders invest in a lot of the properties, along with other people. But there's also, I've learned that they give early access to certain people, and so maybe that's what's happening there as well. So there was one time where they released a property, and I got a link to it just a couple hours early, and so there might be some of that going on. But for the first day, having 85K raised looks pretty great. They don't even have an inspection in here yet. It's possible that the inspection hasn't even been done yet. Um, or an appraisal. And then so far, I actually haven't seen appraisals um, on any of them before they close. See, is that true? I might, that might not be true. But a couple of things. One, with the inspection reports, one of the things that I learned on their last webinar is that might have been the one before, but is that if they anything that comes up in the inspection as a red, that must be taken care of. They're going to either try to get a credit for it, or get it repaired prior to closing. And so they do seem to be negotiating the inspections pretty heavily and getting those items taken care of. And so if they're going to do that, um, I don't know that I need to see it every time, especially as I build more trust in what they're doing here. And one of the things too is I'm buying really little pieces of all these right now. Now, that doesn't mean that I'm not going to do the due diligence, but it means, I'm spreading the risk across a lot of the properties. One of the main benefits of fractional investing, right? But so at a certain point, looking at the return on time that I'm doing, I don't want to, get too deep into the weeds on each inspection when I know that they're doing that already, right? And like I said, I mean, more and more I'm starting to trust that they understand what they're doing. They're looking at, things that they should be. Um, they do have, let's see, let's go into here. They do this maintenance reserve on every property. Um, so and in addition to sometimes you'll see this bigger, it's not that big on this one, but and I believe it's because maybe they don't even have the inspection yet, right? I mean, if they have to change it because they discover stuff, that's something that is possible that it will change. A couple of things that were confusing about this to me, they mention in their note that they got it at a let's see, 4% below asking with an additional 5% seller credit. And all furnishings conveyed, which they're saying over 50,000 value here. Somewhere else they actually say 40K. It might actually be in the listing that it says 40K. The listing for the property itself. I'm not sure, but so slight discrepancy there. But like I said in many other videos, paying for full price for furniture is just not something that we do. But when you get an operating property like this, it is saving you that money from having to invest in it. But I was saying, they're saying they get a 4% discount but it looks like, they're using this 88.5 purchase price, or 885,000 purchase price, which is what it's currently listed for. So I don't know if this is going to be adjusted. I'm really not sure what happened. And actually, too, I found the listing because I have MLS access in Houston, and I found the listing, and it looks like it went pending the first day, and it went straight to pending. It's not active option, which is uh, unusual if you're going to do inspections here in town. So I'm not really sure. It's weird to see that happen on the MLS. And so I don't know if they actually sometimes when an agent does an off-market deal, but they want to get credit for it on the MLS, they'll stick it on there once it's already sold. And so that I think that's possible that that's what's happening here. I'm really not sure. But in any case, 880, 885 is what what the listing shows up as. So I'm not sure if that's truly the discount or if they think they're actually going to get it cheaper than that, 4% less. So, and that kind of leads me to one thing that I want to talk about is I'm a little concerned about the value on this one. Um, let's see, they always provide, is it on here? Yeah, they always provide these comps in this section here. Um, when I went and tried to pull comps in the MLS for this, and the way that I typically do it here in my market is I'm just, going to do a, look in the same subdivision. There weren't really any similar properties, or there's one, and actually I think that it's one that they already have on here. And then, it's just very hard to find any similar comps. And so when I look at these, they're actually, like this one's in the museum district. But what they're doing is actually pulling other operating short-term rentals that are similar physical characteristics of the properties, but the more importantly, they're actually they're income properties in the same way. And so one of the concerns that I have, and when you compare these to those and you look at the income on them, I do think they're comparable properties. But when you're valuing single family homes, the way an appraiser is going to look at that is still very rarely are they using an income approach. And so they're going to do sales comparables, and more often, so I don't think they typically would come up with these same properties as the comps. Now, I could be wrong that it's possible that's not what happens, but one of the things, because they are getting financing, they're going to have an appraisal on these, and so, and I believe they always have an appraisal contingency. That's something I want to actually go back and watch that last one because I think I asked that question. But if not, maybe I'll ask them again. The next one for Mogul, next one of their webinars, I think is Tuesday. If you haven't signed up for it, uh, I've gotten a lot out of every single one that I've been to or been on, and they, any question you put in the chat, they answer the questions in earnest, and typically have good answers on the fly, which I find um, if you can get a good answer when somebody's answering you in real time versus like I send them an email and I got one, like that's a big part of what's built some trust with me with them. Is they, I really think they know what they're doing as far as that goes. But in any case, it still worries me a little bit, right? And I think that there is, in general, in the real estate investing space, this move towards paying more for operating short-term rentals. And a lot of people believe that you're going to eventually just value them just like you would commercial property, where you do a cap rate, you're paying for the income. And I think that on the margins, you're seeing that happen, right? There's sales that are happening that way, but it's really hard for me to believe that that it's going to go in that direction completely, because at the end of the day, it's still just a single family home. It might be a fantastic home in a great location, but it's still I don't know. It's tough for me to believe that you'll have single family residential properties being valued like commercial properties, on average, right? And so it's one of the things that scares me a bit, and it also, as an industry, right? If something major, excuse me, happened and they couldn't operate these as short-term rentals, um, especially where they're buying a whole bunch in the same area, it's going to have a lot, and there's a whole bunch of comps too in that area. Let me show you this. These are all short-term rentals in that spot, right? And so obviously some of these are a lot smaller. They might be, yeah, some of them are bigger, but there's just the density of them in this part of town is just, pretty. It's just very dense, right? And so if all of a sudden none of these people were allowed to operate as short-term rentals, they'd probably all end up on the market because most of them are not going to be able to work as a long-term rental, right? I want to use that toggle and see what this says. Toggle it to long-term rental. Yeah, you're going to lose money on a cash on cash basis, and they think you're going to lose money on IRR basis. And I agree with them. I think that it's extremely unlikely if you operated this in any other way that you'd make money. I think the exit strategy would be okay, sell it, and let's try to not get too hurt, right? Now, how big of a risk is that? That's anybody's guess, right? But it's just one of the things I like to think about. The more I invest in a single type of business in a certain area, like for example, I mean that could happen just as short-term rentals just in Houston, uh, or you could see some like sort of. I really don't think we'd ever see a nationwide, hit to them, but you might see a change in preferences if there was, that could really hurt them all. So I don't know, just something I wanted to mention as far as valuation goes, right? So I start to get a little bit worried when these properties really get valued as income producing properties. At the same time, you can see that you can see this map and these are income producing, like this whole part of town is basically just full of income producing properties, and so to value them like that starts to make some sense. I did check the Zillow pricing as well, just to see what they were thinking, because like I said, I mean it was very hard to find good comps that were similar size in the same subdivision. They put his estimate of 841, little bit below where it is. So, I don't love that, but it's not so far off. Um, it does appear from, based on, that we're paying a little bit of a premium. Again, I think, once you see the appraisal, they're not going to be paying above appraised value. I don't believe. So far, I haven't seen that happen. Because we typically have a contingencies for that in our financing, and you just don't have to move forward. I trust their operation well enough at this point that I don't think, that I don't believe that that's something that they do. Who knows? Maybe they would, and that's going to cause me problems in the future. But at the moment, especially because I'm just picking up little pieces of every single one, if that were to happen, I'm not going to be too hurt. This is one of the things I was looking at homes.com. This home is very high priced for the neighborhood, which is usually pretty worrisome. It's because it's a large home, though. If you looked at values per square foot, it's still on the higher side, but it's not. It's not a, it's higher side, but it's very close to the average price per square foot. So that made me feel pretty good about it from that perspective. And it is a nice property. It's a relatively recent rehab. When you go back and look at older pictures, this rehab was done. My guess is right before this started operating as an Airbnb. I'm not positive that's the case. Um, I also, checked the flood map. That looked fine. In Houston, every time I've looked, there's been, just a little bit higher crime than in a lot of the other places that we've looked. You've got some burglaries, some thefts, some assaults. This is a very dense area. Nothing within a couple of blocks there, but plenty of stuff nearby. And I went through here. It didn't take very many days, right? This was only, how many days was this? Like 5 days, 4 days of data, 4 days of data. So, um, again, this is something that would worry me a bit. But, I go back to this has been operating for 2 years successfully without any bad reviews related to the area, right? Like that's one thing that guests will complain about in their bad reviews. And I didn't see any, and I only read the bad reviews. So sometimes people will give a 5-star review, but then say, oh, but you have to realize what this neighborhood is like. So I don't, if you've read them all, maybe you'd find one that mentioned it. But no, none of the bad reviews were related to that, and so that makes me feel pretty good that that in the 2 years of operation, uh, overall, you know, makes me think that the guests are not having as big of a problem here. And then if you remember when we talked about this in one of the other short-term rentals that they had is, when I was looking at the comps, and this was in Houston as well, and this was one of them that I didn't buy, is all of the comps had gates, right? And had like you could drive in and close the gate, and that one didn't have that. And I think that's a little bit worrisome in an area that does have a little bit higher crime, right? And so here you've got a gate. Um, it looks like it's an automatic gate too, like with a keypad, which, you know, if that's what this is, I don't love those. It's weird that it's on this side, but I don't love those because they tend to break a lot, so it's a maintenance headache. And maybe that's just the ones that I've had, but I've had that experience quite a bit where, automatic gates can just be a problem. Uh, but anyway, having one in a property in an area like this is just really fantastic. Like, this is not, you look at the size of the home and it's a good size, but it's also the lot is situated really well, right? Like the way the parking is, the how private the backyard is. It'd be interesting if sometime in the future they decided to stick a pool here too. Like, one of the things though I started to think about is, even though I have a strong preference for pool properties, um, where they're operating several of these, it is nice to not directly compete with the other ones that they have nearby, right? And so it's probably going to be different price point for their similar sized property because one's got a pool and one doesn't. So I don't know. I think that for me, the actual 2 years of operating history, the way it is, is overcoming a lot of the stuff that if that hadn't been in place, I'd be, would worry me, especially because in their underwriting, they're picking, they're assuming that they're not even going to do as well as the current host. Um, I'm not really sure that what that is. So from the income perspective, and from it working as an operation, I feel pretty good. The valuation, it is, to me, it is a little bit iffy, right? I mean, okay, we're a little bit on the high side as far as price per square foot. Um, we're a little bit above what Zillow thinks. They're having to look at comps that are just income producing, Airbnbs that are very similar, um, which in some ways makes a ton of sense. But I'm just not convinced that the market is really there yet. That's the way these properties are going to be priced yet. Um, what else do I want to touch on this? So the only, my worry with that is, on the sale, if we aren't able to sell it to another investor, it might be a property that we just have to hold forever to continue to collect the yield, right? And especially because it looks like they're a little bit conservative on their yield projection, and it is on the lower side, right? I mean, it is. We've had some that are 10 and 11 and even higher. Um, for a property like this in a market like Houston, I don't need a double digit cash on cash yield all the time. I'd prefer it, right? But because um, because I believe it's a growing market, and I think you'll get the benefits, of long run better returns. I think that works perfectly fine for what I'm looking for. They do have a 4% income growth assumption. I think that makes perfect sense because of their current operation, right? Like, I think because they're saying, okay, we're assuming we're making less than they are year one, and their growth doesn't even look like they hit that same number until year 8, right? And so that seems, in my mind, that's a pretty conservative way to look at this. They are assuming a refinance. And I think is this a cash out refinance they're doing? Yeah, and taking a significant amount of cash out. Now, what happens if we get rid of that and look at the total returns? Okay, still, low teens IRR. Again, I think, I don't love it when they do, when they assume they're going to be able to refinance and take cash out. At the same time, um, I don't know. It's funny to me, right? Like when they started to do that with all their properties, I can tell, and I think it makes some sense because I believe our financing is going to get better in the future than it is right now. But I want to see like what is it going to look like if it can't, if rates don't come down at all, if there's not some ability to refinance, and the other option, the other reason they might be able to too is just, the property's performing so much better and they're getting some appreciation. They are using a pretty big appreciation rate at this point. We went from 3 to 3.5 to 4 on the Houston properties that I've looked at for Mogul. Um, that worries me a bit. I don't know why that's moving up. It's kind of funny because I feel like it seems like they're being very conservative on their income side, and then much less so on their appreciation and valuation. Um, I'd rather just have, both be sort of match up and be realistic. I mean, you could tell, I think you could probably tell the way I've been talking about this the whole time. I'm planning to buy a little piece of this one. I think that, it seems like one, it's the Houston market's the market I like. I'm a big fan of short-term rentals. I really love that it's been operating for a couple of years and they're projecting numbers that are below the way it's been operating, and like maybe that makes a lot of sense because your first year getting things worked out, having a new listing up, you might end up running into some problems, right? And not doing as well as the property had been doing. But I mean, especially even if that's the case, I think in the next couple of years you just expect to get there pretty quickly. Not have to move pretty far out to hit. And when I'm saying it gets to that 168, I mean that's what I saw on awning. What's interesting is they're saying it gets, they're saying that it's been 130, but the payout, right? So, um, but they are. I mean, they're using a pre-fees number versus post-fees. So, yeah, I mean, it seems like they're being really conservative on the income side, but then I'm not sure that I'm 100% bought into the way they're valuing it. So, a little bit, we always talk about my, rule number one, don't lose money. Um, as long as we get to hold this as long as their plan goes, I think that we wouldn't. Let's see. Trying to think about, and it's tough to be a forced seller provided it's operating as well as it looks like it should be. It's just if you bought it and then had to sell it immediately, you'd lose money. But that's the case with all of theirs because even the ones that have a little bit of a discount that they're buying with, you're still having to overcome all their fees and everything. And so that's, I think I can live with that. It's really only a matter of if for some reason on exit we can't sell to another investor who's or or they're not valuing them the same way that we are today, and to be like I'm seeing a lot of other investors do the same thing, right? There people are buying and selling these properties and paying premiums for them being well operating properties. um so I don't know. That you can tell I'm a little bit hesitant about it, but it is, for me, uh, especially because I'm just doing a little piece and I'm trying to just collect a whole bunch of these that they're putting up. Now that being said, one of the things that I worry about a little bit is, from them so far. Let's see, what do I have? I've got short-term rental in Houston. This will be another short-term rental in Houston. This is a rent by the room in Decatur, Georgia. But then another short-term rental in Houston. And oh, this is a rent by the room in Mesa, Arizona. And then a short-term rental in Houston, right? And so as much as I want to um get some diversification, I'm not getting it as much here, right? Because it's although they're not all right next to each other, and they are, each property is quite a bit different from the others when I really start to think about it. So that I like that. Um, but if they just keep putting out those same ones, at a certain point, I'll probably stop buying into them. Um, I think not anytime soon, though. I mean, as long as they're continuing to operate them well, I'm investing in plenty of other platforms and other locations, and so I'm not too worried about it. I think what's happening, they're not located in Houston. I think what's happening is they've found that's where they're able to find good deals that are, paying for themselves well as far as from a business plan perspective. And so it makes a lot of sense that they just go, oh, no, this one's in Austin then. That's true. Houston, Austin. Let's look again. Houston, Houston. Okay, well that makes me even feel a little bit better. This was the one in Houston that I didn't buy too. So all right, well that's even better. So they're casting a really wide net, but I think that they just happen to be finding more deals in Houston because it's a market that the revenue to price ratios look good. I'm really worried, or not worried, but wonder why they're not in San Antonio yet because um, I feel like our revenue to price ratios are just as good. One of the things I guess is maybe we don't have a lot of turnkey ones that come up for sale here for some reason. We have a lot like most of the ones that I'm helping clients buy are they're buying a vacant home, furnishing it, and then going from there. So maybe that's what it is because it does seem like they have a strong preference for ones that are already operating. I think that makes a ton of sense. Um, anyway, yeah, I'm gonna pick up a little bit of this one. Um, again, just because I buy it doesn't mean that you should. I forgot until now, but please like and subscribe. And in the description to this video, there are links to all the sites that I currently invest on in for fractional real estate. Some of those links will give you free money if you use them, but do your own due diligence on the sites and on the properties that you buy on those sites. Just because I'm buying on there doesn't mean that you necessarily should. And that is it and there's also a link to our Discord in there as well. Um, there's a whole bunch of us investors now that get on there, talk to each other regularly about investing strategies, about specific properties, some of the platforms, all that sort of thing. So you're invited to do that. And now I'm really done. So until next time, I'm going to keep making mistakes so that you don't have to.